Let's get concrete. Picture this. Sarah needed $78,000 that year for home repairs and unexpected medical bills. Every single dollar she withdrew from her traditional 401k pushed her modified adjusted gross income higher. That triggered a bigger Medicare Part B premium, what the system calls IRMAA. She also crossed a Social Security taxation threshold, which increased the taxable portion of her benefits. In just a single year, her effective tax rate spiked, creating stress and limiting her financial flexibility. This is the reality of a single-bucket retirement. Even decades of disciplined saving can feel fragile if all your funds live in one type of account. Now compare that to someone who planned their roads early. Marcus, for example, spread his contributions across traditional, Roth, and taxable accounts while still working. When he retired, he had the ability to withdraw strategically. Roth withdrawals to avoid tax triggers, taxable brokerage withdrawals timed to maximize the 0% long-term capital gains bracket, and traditional account withdrawals only when necessary. The result? His effective tax rate stayed low, his Medicare premiums remained manageable, and his Social Security inclusion stayed minimal. He didn't just save money. He built a system that allowed him to make choices each year instead of reacting to forced formulas. Here's the key takeaway. It's not how much you saved, it's where you saved it. Every dollar in a single pre-tax bucket risks being trapped, forcing you into higher taxes and additional Medicare costs. Diversifying across multiple roads creates flexibility, reduces forced tax events, and allows you to control your income instead of letting the IRS control it for you. And the best part? Midlife adjustments, shifting contributions to Roth accounts, funding a taxable brokerage, or planning Roth conversions can still give you decades of compounding advantage. We're going to dive deeper into how to create these roads, the optimal timing for Roth conversions, and why a 2 to 5 year early retirement window can be the most powerful period for reducing lifetime taxes. You'll see examples from Rye, Marcus, and Sarah, illustrating exactly how their strategic choices, or lack thereof, shaped their retirement experience. By the end, you'll know how to audit your accounts, identify risks, and create a roadmap that protects your wealth and your freedom. This is where most people fail to plan. They think hitting a number is enough. They think a traditional 401k or IRA guarantees safety. But without creating multiple roads, that number becomes a trap. You'll learn to avoid that trap and give every dollar a path to reach you intact, ready to fund your lifestyle, not the government's coffers. Think about your current paycheck. For every $100,000 you earn, the IRS, Social Security, Medicare, and state tax authorities take their share before you ever see a cent. FICA alone claims 7.65%, and that's before federal or state income taxes. Add commuting costs, work lunches, and other employment-related expenses, and the money that actually lands in your bank account is often significantly less than your gross earnings. Now, imagine the same $100,000 coming from retirement income, Social Security, a pension, withdrawals from strategically allocated accounts. Suddenly, many of those toll booths disappear. FICA is gone entirely. The expanded standard deduction reduces taxable income, and long-term capital gains may fall into the 0% bracket if you've planned correctly. That same amount of income, same source dollars, flows to your bank account far more efficiently. Let's put numbers to this. Take Bob, a retiree earning $100,000 from a mix of Social Security and carefully structured investments. In a typical year, he might pay just a few $100s, or in a perfect setup, nothing, federal taxes. Meanwhile, someone still working that $100,000 could be sending $15,000 or more straight to the IRS. That's a 50 times difference. The gap isn't luck, it's the structure of the tax code. Retirement income has fundamentally different rules, and understanding them is the key to minimizing tax exposure. Rye leveraged these rules by using his low-income post-retirement years to execute Roth conversions at a low effective tax rate. By the time his Social Security kicked in, he had a multi-road portfolio with both tax-free and taxable accounts, reducing his lifetime tax burden dramatically. The first layer of the difference is FICA. When you earn wages, 6.2% goes to Social Security and 1.45% to Medicare. Your employer matches that amount, but it's effectively a cost of employment. Retirees don't pay this on investment withdrawals or Social Security benefits. Just this single factor, compounded over a lifetime of investments, can amount to hundreds of thousands of dollars in extra wealth retained. The second layer is the standard deduction, which increases once you and your spouse reach 65. This alone can shelter a significant portion of your retirement income from taxation. Finally, the long-term capital gains tax structure allows retirees to sell investments they've held for more than a year without triggering federal taxes if their taxable income falls below the threshold. Bob leveraged all three layers. Sarah, in contrast, had no alternative roads and fell into higher taxes on every withdrawal. But here's where the numbers really get interesting. These differences don't just affect your tax bill. They influence how much you actually need to retire comfortably. Many calculators apply your working tax rate to projected retirement income, overstating the savings required. If you structure your withdrawals correctly, your effective tax rate could drop from 20% to as low as 2 to 5%. That's not just theoretical. Marcus achieved this by distributing his portfolio across traditional, Roth, and taxable brokerage accounts, drawing strategically to avoid unnecessary taxes and IRMAA penalties. Even with the same total savings, he had tens of thousands of dollars more available each year than a single-bucket retiree. The key lesson: knowing the rules isn't enough. You have to act on them. Roth conversions, taxable brokerage accounts, and even careful sequencing of withdrawals can transform the road your money travels in retirement. Rye's 2-year conversion window shows the power of timing. Marcus's multi-road strategy shows the power of diversification across account types. And Sarah's story is a warning of what happens when you ignore structure entirely. By understanding the differences between working income and retirement income, you can make midlife adjustments that pay off for decades, turning potential tax shocks into controlled, predictable outcomes. So here's a practical exercise. Take a look at your current portfolio. What percentage of your wealth sits in pre-tax accounts? Roth? Taxable brokerage? Understanding the composition of your accounts is the first step toward creating the multiple roads that will allow your money to flow efficiently in retirement. Later, we'll cover step-by-step actions to redistribute contributions and plan Roth conversions during low-income years, giving you maximum flexibility while minimizing lifetime taxes. Understanding the working versus retired tax gap is the foundation of strategic retirement planning. It's the reason why disciplined savers sometimes end up paying more taxes than they ever imagined, and why small structural adjustments can yield massive long-term benefits. This is your opportunity to stop handing extra money to the IRS unnecessarily and take control of your retirement journey. Now let's zoom in on Sarah's situation to understand what went wrong. She retired with $1.8 million, all neatly parked in a traditional 401k. She did everything right by conventional advice: max contributions, disciplined saving, diversified investments. On paper, she had achieved financial freedom. But the moment she needed to spend her first $78,000 for home repairs and medical bills, every dollar she withdrew was treated as ordinary income. That triggered higher federal taxes, bumped up her Medicare Part B premiums through IRMAA, and increased the portion of Social Security counted as taxable. Suddenly, her well-earned savings felt like they were being siphoned off by formulas she hadn't fully accounted for. The problem was simple but critical. Sarah had a single-bucket retirement. Every dollar she owned was funneled through one type of account, leaving her no flexibility. Unlike Marcus or Rye, she couldn't strategically choose which accounts to draw from to minimize taxes. There was no multi-road system guiding her money efficiently to her bank account. The toll booths, the tax layers, were fully staffed. Each withdrawal triggered a chain reaction she couldn't avoid, forcing her into a higher effective tax rate and unnecessary penalties. To put this in perspective, think about your money as cars on a road. When all cars are forced onto the same lane with toll booths, each one pays the full fee every time. Sarah's traditional 401k was that single lane. She had built wealth for decades, yet in the critical years post-retirement, she had no choice but to pay every toll at full price. Contrast that with Marcus, who built multiple roads, a traditional account, a Roth, and a taxable brokerage. He could send some cars down the Roth road, no tolls, fully tax-free. Others traveled the brokerage lane, where long-term gains could be withdrawn at 0% if timed properly. The result? The same total wealth delivered far more spending power and flexibility. Now, consider the numbers. Sarah's RMD at age 73 would force roughly $73,000 into ordinary income. Add Social Security and pension income, and her taxable income could easily push her into a 22 to 24% bracket. Her Medicare premiums jumped accordingly. Multiply this over a decade, and suddenly hundreds of thousands of dollars were lost to taxes and surcharges, not because she hadn't saved enough, but because she lacked options. Every dollar coming out of that single bucket was exposed. Rye's experience illustrates the solution. He had $2.1 million in a traditional IRA when he retired, and he had a 2-year runway before Social Security started. Using that window, he converted approximately $180,000 per year into a Roth IRA at a low effective tax rate. Simultaneously, he harvested gains in a small taxable account at the 0% long-term capital gains rate. By the time his Social Security kicked in, his traditional balance had decreased, his Roth had grown, and future RMDs were substantially smaller. The same principle applies midlife. If you start building multiple roads before retirement, you create options that minimize the tax tolls on your money. The critical takeaway is this: the single bucket problem isn't about not saving enough, it's about structure. Wealth stored entirely in pre-tax accounts may look impressive on paper, but can force you into high taxes and reduced flexibility when you need money most. Multi-road planning, splitting savings among traditional, Roth, and taxable accounts, creates optionality. It allows you to navigate the tax code efficiently, avoid unnecessary Medicare penalties, and control how much Social Security becomes taxable. Even a modest reallocation can have huge consequences. For example, redirecting a portion of future contributions to a Roth 401k or starting a taxable brokerage account doesn't just grow your wealth, it buys freedom. You gain control over which dollars to spend, when to spend them, and how to manage your lifetime tax exposure. This is exactly what Marcus did, and it's why his retirement spending power far exceeded Sarah's, even with similar total savings. Ask yourself, if all your wealth were in one account, how would an unexpected $10,000 or $20,000 expense affect your taxes and Medicare premiums? Would you have to take more from your 401k, inadvertently pushing yourself into higher tax brackets? Or would you have multiple roads, giving you the ability to withdraw strategically, minimize taxes, and protect your spending power? Understanding the single bucket problem is the first step to avoiding the same trap Sarah fell into. By creating multiple roads, you're not saving more, you're spending smarter. You're structuring your wealth to work for you, not against you. The toll booths, the IRS, Medicare surcharges, Social Security taxation can be managed if you plan ahead. Ignoring this leads to unnecessary stress, wasted money, and a retirement that feels rigid instead of free. Next, we'll explore exactly how Marcus's multi-road approach works, including the specific ways to sequence withdrawals across traditional, Roth, and taxable accounts to minimize taxes and maximize flexibility. You'll see real numbers, real outcomes, and actionable steps that you can start applying today to ensure your money reaches you intact, instead of paying unnecessary tolls along the way. Now that we've seen the cost of a single bucket retirement, let's explore how multi-road planning can completely transform your retirement experience. Marcus's approach is a perfect example. He split his savings across 3 roads: a traditional 401k, a Roth account, and a taxable brokerage. Each road has unique tax rules, giving him flexibility to manage withdrawals, control his effective tax rate, and avoid surprise Medicare surcharges. The strategy isn't about saving more. It's about structuring what you already have so that every dollar can travel the path that reaches you most efficiently. On the traditional road, Marcus contributed up to his employer match. This is free money, an immediate 100% return. Beyond that, he was careful not to overload this road, because every extra dollar would eventually be taxed as ordinary income during retirement, with no flexibility. The Roth road, in contrast, offers a different kind of power. Contributions are made with after-tax dollars, but withdrawals in retirement are tax-free. Roth accounts don't trigger Medicare surcharges, don't affect Social Security taxation, and aren't subject to required minimum distributions. This makes them the ultimate tax-free lane, money that can be accessed without triggering cascading tax consequences. The third road, the taxable brokerage account, is where Marcus parked extra contributions beyond Roth limits. These funds are invested in broad, low-cost index funds and held for more than a year to take advantage of long-term capital gains rates. Strategic withdrawals from this account allow access to gains at 0% if taxable income stays below the threshold. The brokerage road has no contribution limits, no mandatory withdrawals, and the government doesn't dictate when or how much you can access. This is the road that gives you maximum optionality in retirement, the freedom to spend strategically without triggering unnecessary taxes. Here's a concrete scenario. Suppose Marcus needs $100,000 to maintain his lifestyle. Instead of withdrawing it all from a traditional 401k and facing high taxes and IRMAA surcharges like Sarah, he pulls $30,000 from the Roth, $30,000 from the taxable brokerage, and $40,000 from the traditional account, carefully timed to avoid crossing thresholds. The effective tax rate stays in the single digits. He has choice. If the tax environment shifts, if unexpected expenses arise, he can adjust which road to draw from. Each year, Marcus can optimize withdrawals based on his needs and the rules in place, rather than being forced down one predetermined path. This multi-road approach also provides psychological benefits. Knowing that not all your wealth is exposed to the same toll booths reduces stress. You're no longer reacting to mandatory withdrawals or sudden tax increases. Instead, you control your income flow, choosing how to manage your tax liability and spending each year. This level of freedom allows retirees to enjoy their money without fear or hesitation, which is a major factor often overlooked in retirement planning. Rye's experience demonstrates the power of timing. He had a 2-year window post-retirement before Social Security started. During this time, he converted a portion of his traditional IRA into a Roth at a low tax rate while harvesting gains from a small taxable account. By the time Social Security kicked in, his traditional account had decreased, Roth had grown, and future required minimum distributions were smaller. The combination of multiple roads and strategic timing created tens of thousands of dollars in tax savings over his retirement. It's not a complex formula. It's thoughtful sequencing and account allocation. For midlife viewers, the message is clear. Building multiple roads today sets the stage for decades of financial freedom. Even small shifts, diverting a portion of contributions from traditional to Roth, opening a taxable brokerage account, or planning Roth conversions in low-income years, can dramatically alter the landscape of your retirement. Each dollar placed in the right road is a dollar shielded from future tax tolls. The difference between a rigid, stressful retirement and one with options and flexibility is entirely structural. So here's a question to consider. If an unexpected $20,000 expense arises in retirement, do you have the freedom to choose the source that minimizes taxes? Or are you forced to take it all from one account, triggering penalties and surcharges? Multi-road planning gives you the freedom to make those decisions strategically. Your portfolio becomes a system of choices, not a single track with every dollar at risk. Next, we'll dive into Roth conversion windows, the specific timing strategies that maximize tax-free withdrawals, and how even retirees with predominantly traditional accounts can bend the tax curve in their favor. This is the step that turns theoretical flexibility into actionable savings and ensures your roads are ready long before the toll booths appear. Now that you understand the power of multiple roads, let's focus on one of the highest leverage strategies for managing taxes in retirement: Roth conversion windows. The idea is simple but incredibly powerful. During the years immediately after you stop working and before Social Security or pension income kicks in, your taxable income is often lower than it will be in later years. This is your chance to convert portions of your traditional 401k or IRA into a Roth account, paying tax at a lower rate while creating a source of tax-free income for the future. Rye's experience provides a clear example. At retirement, he had $2.1 million in a traditional IRA. Without planning, every withdrawal over time would have been taxed as ordinary income, triggering higher Medicare premiums and increasing the taxable portion of his Social Security. But Rye had a 2-year runway before Social Security started. During that window, he converted roughly $180,000 per year into a Roth. Because his income was low during this period, his effective tax rate was much lower than it would have been if he had waited. At the same time, he sold some appreciated investments from a small taxable brokerage account. Since he had held these assets for more than a year, the gains qualified for the 0% long-term capital gains rate. By the time Social Security began, Rye had lowered his traditional account balance, grown his Roth, and set up smaller future required minimum distributions. The impact? Tens of thousands of dollars saved in taxes over the course of his retirement. The concept of the Roth conversion window is all about timing. Your low-income years post-retirement are finite, typically spanning 2 to 5 years, depending on when you retire and start Social Security. Missing this window can be costly. Consider a retiree who waits until age 73, when RMDs begin. Any conversions done after that point will likely push you into a higher tax bracket and trigger Medicare surcharges, eliminating much of the advantage. The window is not just an opportunity, it's a strategic imperative for maximizing flexibility and minimizing lifetime taxes. It's important to recognize that Roth conversions aren't magic. They require paying income tax up front on the amount converted, which can feel like a loss in the short term. But the benefit is long-term freedom. Withdrawals from a Roth do not count toward your modified adjusted gross income, MAGI, in the same way as traditional withdrawals. This means they don't increase Medicare premiums, don't push Social Security into higher taxable brackets, and don't interfere with the 0% long-term capital gains rate when used in combination with taxable brokerage accounts. The dollars you move into a Roth today travel a toll-free road tomorrow. For midlife viewers, this strategy can still be applied proactively. Even if you're in your 40s or 50s, creating a Roth component in your savings, whether through a Roth 401k, Roth IRA, or taxable brokerage contributions, sets the stage for a future conversion window. You can begin building multiple roads now, so that when the low-income years arrive, your portfolio has the flexibility to convert and withdraw strategically. Marcus followed this approach. By allocating contributions across traditional, Roth, and taxable accounts during his working years, he ensured he had options during retirement, rather than being forced into a single bucket scenario like Sarah. Let's break it down numerically. Suppose you can convert $100,000 in a low-income year at a 12% effective tax rate. You pay $12,000 now, but that $100,000 grows tax-free for decades. Future withdrawals are fully tax-free, don't trigger IRMAA surcharges, and reduce the size of your traditional accounts, which in turn reduces future RMDs. Over time, this can represent hundreds of thousands of dollars saved in taxes, all while maintaining or even increasing spending flexibility. Timing and sequencing matter even more when considering surviving spouse or widow scenarios. For example, a widow who didn't convert during low-income years after her spouse's death may face dramatically higher taxes due to the widow's penalty, where brackets and thresholds are effectively cut in half. By taking advantage of Roth conversion windows earlier, you can mitigate this risk, creating a tax-efficient road that remains intact even if circumstances change. The key takeaway is this: the Roth conversion window is a strategic lever that lets you bend the tax curve in your favor. Ignoring it leaves you exposed to the single bucket problem and the compounded impact of ordinary income taxation, Medicare surcharges, and Social Security taxation. Leveraging it correctly gives you freedom and optionality, turning a rigid retirement into a flexible, controlled financial journey. By planning ahead and using Roth conversions during low-income years, you can maximize tax-free income, reduce future RMDs, and protect Social Security benefits. This is why multi-road planning, combined with well-timed Roth conversions, is the cornerstone of a stress-free, financially efficient retirement. Comment your retirement age. Next, we'll cover practical steps you can take today to prepare for these Roth conversion windows, even if you're still a decade or more away from retirement. You'll learn how to audit your accounts, adjust contributions, and schedule conversions to take full advantage of this high-leverage opportunity. By now, you've seen the real cost of a single-bucket retirement and the power of multi-road planning combined with well-timed Roth conversions. But all of this is only valuable if you take action today. Let's talk about concrete steps you can implement immediately to put your retirement on the right path. The goal is simple: create multiple roads, reduce future taxes, and ensure flexibility. Step 1 is auditing your current accounts. Take a close look at your portfolio and calculate what percentage sits in traditional pre-tax accounts versus Roth accounts and taxable brokerage accounts. If more than 80 to 90% of your wealth is in pre-tax accounts, you're essentially on a single bucket path. Even if your total savings look impressive, the structure could be costing you tens of thousands of dollars each year in taxes and Medicare surcharges once RMDs begin. Understanding where your money is and how it flows gives you the clarity to make changes that will matter for decades. Step 2 is adjusting future contributions. If your employer offers a Roth 401k option, consider splitting contributions between traditional and Roth. A starting point could be a 50-50 split. Continue to capture the employer match in the traditional account while allocating additional contributions to the Roth. For Roth IRAs, be aware of the income limits in 2026: $7,000 per year per individual, $8,000 if over 50. For higher earners, Roth 401k contributions bypass the IRA income limits, allowing up to $31,000 per year if you're 50 or older. This creates a second road, giving you tax-free options in retirement that are invisible to Social Security taxation and IRMAA calculations. Step 3 is establishing a taxable brokerage account if you don't already have one. This is your third road. Contributions here are after-tax dollars, but the investment growth can be withdrawn strategically under favorable long-term capital gains rates. Unlike retirement accounts, there are no RMDs, no contribution limits, and withdrawals can be timed to fit your income strategy. This road may not feel as exciting as tax-deferred or Roth accounts, but it provides unparalleled flexibility. It's where you can manage unexpected expenses or take advantage of market opportunities without triggering a tax storm. Step 4 is planning for Roth conversion windows. Even if you're years away from retirement, you can create a roadmap now. Identify periods when your taxable income is likely to drop, perhaps a career transition, sabbatical, or the early years after stopping work. Label these as Roth conversion windows in your calendar. Model potential conversions and tax impact in advance. For example, converting $100,000 in a low-income year at a 12% effective tax rate creates tax-free growth for decades and reduces future RMDs. Even small, strategic conversions can accumulate substantial savings and reduce your lifetime tax burden. Step 5 is sequencing withdrawals in retirement. Once you're retired and have multiple roads built, the next challenge is choosing which account to draw from each year. Start with Roth funds for tax-free income. Supplement with taxable brokerage withdrawals to maximize the 0% long-term capital gains bracket, and only draw from traditional accounts when necessary to meet lifestyle needs. This sequencing reduces effective taxes, keeps Medicare premiums lower, and protects the portion of Social Security that remains untaxed. The difference is dramatic. A retiree using this approach can maintain the same lifestyle as a single-bucket retiree while paying a fraction of the taxes. Step 6 is ongoing monitoring. Tax laws, income thresholds, and Medicare rules change over time. Congress could adjust the 0% capital gains bracket or modify Roth benefits. The key is not to predict the future, but to build optionality. By having multiple roads and monitoring your accounts, you maintain control and can adjust your strategy to take advantage of changes. Lazy investors often get lucky by building the right structure. Active monitoring ensures that luck is intentional. Finally, consider the emotional impact. Knowing your money flows efficiently reduces stress. You're not reacting to mandatory withdrawals, surcharges, or unexpected tax bills. You're making choices every year that optimize your tax exposure and protect your lifestyle. This control is just as valuable as the money itself, and it compounds over decades. Midlife is the perfect time to implement these steps because you still have runway before retirement. Decisions made now create decades of optionality, lower taxes, and more secure retirement income. Take action tonight. Audit your accounts, adjust contributions, open a taxable brokerage if necessary, and map your Roth conversion windows. The time to build multiple roads isn't after retirement, it's now, while you have income, contribution eligibility, and flexibility. Even a small change today can translate into tens or hundreds of thousands saved over the next 20 to 30 years. By structuring your accounts thoughtfully, you ensure that when the toll booths come, your money reaches you intact, ready to fund your lifestyle, not someone else's. We've covered a lot, but let's step back and look at the bigger picture. Sarah's story showed us the dangers of a single-bucket retirement. High taxes, inflated Medicare premiums, and Social Security becoming partially taxable. Marcus and Rye showed us the opposite. Strategic planning, multiple account roads, and well-timed Roth conversions gave them options, flexibility, and control over their retirement income. The key lesson is simple. It's not just how much you save, it's where you save it and how you plan your withdrawals. Structure matters more than size. By building multiple roads, traditional, Roth, and taxable brokerage, you create freedom. Each dollar has a path to reach you efficiently, avoiding unnecessary tolls along the way. Strategic Roth conversions during low-income windows reduce future tax exposure, while taxable accounts allow you to harvest gains at the 0% capital gains rate. The result is a retirement where you can make choices rather than follow a rigid formula. A retirement where you maintain control over your lifestyle without surprises from the IRS or Medicare. Remember Rye's 2-year window. By converting $180,000 per year from his traditional IRA to Roth at a low effective tax rate, he not only reduced future RMDs, but also maximized tax-free growth for decades. Marcus did something similar by splitting contributions and sequencing withdrawals from multiple accounts, keeping his effective tax rate in the single digits while maintaining the same lifestyle. These aren't hypothetical scenarios. They're real outcomes achieved by real people who took the time to structure their savings correctly. Now, imagine yourself in that scenario. What if every dollar you saved had a designated path? What if an unexpected $20,000 expense didn't force you into a higher tax bracket? What if your Social Security remained largely untaxed and Medicare premiums stayed predictable? That's the power of multiple roads and the value of understanding the Roth conversion window. Even small adjustments today, auditing your accounts, reallocating contributions, or opening a taxable brokerage, can compound into tens or hundreds of thousands of dollars saved over your retirement. Here's the core takeaway. Retirement isn't just about hitting a savings number. It's about creating flexibility, reducing unnecessary taxes, and maintaining control over your income flow. Many people think they're safe simply because they've accumulated wealth. But without proper structure, even millions in the bank can feel rigid and constrained. Sarah had $1.8 million, but she faced tax surprises and limited choices. Marcus and Rye had similar or smaller balances, but enjoyed far greater freedom and efficiency because they built multiple roads. For midlife viewers, the message is urgent but empowering. You still have time to audit your accounts, adjust contributions, and plan Roth conversions during low-income years. You can design your retirement roads to ensure your money travels efficiently, maximizing spending power and minimizing tax exposure. The decisions you make now, while you still have income, contribution eligibility, and flexibility, will set the stage for decades of control and peace of mind. Before we close, let's reinforce 3 actionable points. Audit your accounts. Know exactly how much sits in traditional, Roth, and taxable accounts. Awareness is the first step to control. Adjust contributions. Use Roth options where possible, and consider taxable brokerage accounts for surplus savings. Even modest adjustments compound into substantial benefits. Plan Roth conversion windows. Identify low-income years, model conversions, and execute strategically to minimize lifetime taxes and future RMDs. By following these steps, you're not just saving money. You're designing a system that protects your lifestyle, avoids unnecessary tolls, and creates optionality for decades. Retirement should be a time of freedom, not forced decisions dictated by tax brackets or mandatory withdrawals. Structure your savings correctly, and you can enjoy your money on your terms. Comment your retirement age. Finally, remember this: your future self will thank you for planning today. The freedom and control you create now are far more valuable than chasing the highest savings number alone. Multiple roads, smart conversions, and strategic withdrawals are the keys to turning decades of disciplined saving into decades of flexible, stress-free retirement. Take control. Act now, and make your money work efficiently for you. Your future self is counting on it. Your future self thanks you for watching.